Good morning. I would like to welcome you to the Asia Impact webinar series. In pursuing our mission of building meaningful lives, the Milken Institute is tapping into our unique ability to convene leaders from across sectors and markets, and we're partnering with the South China Morning Post to lead global conversations about Asia. The Asia Impact webinar series will focus on the key issues shaping the future of the region. Today's episode will focus on corporate governance and how we can make or break a corporation. And now, I would like to pass it on to Gary Liu, the CEO of the South China Morning Post. Thank you for joining us today.
As the world continues to grapple with the pandemic, the experience of many Asian countries in recovery could well be a guide on how the globe resumes social and economic activities safely and with innovation. The SCMP is pleased to collaborate with the Milken Institute in bringing you these important explorations on how Asia is defining a new normal, creating safer, more resilient, and more connected systems for the post-COVID world. We trust that you will benefit from the expert insights in today's webinar.
Hello, and welcome to our webinar on corporate governance in the time of COVID-19 and rising US-China tensions. I'm Alison Tudor-Ackroyd, SCMP's finance editor, and I'll be your moderator for the next 45 minutes. We'll have a Q&A session at the end of this discussion to try and make this as relevant to you as possible. I'd now like to introduce our panelists for today, starting with Boon, Chye, CEO of Singapore Exchange, Matthew Ginsberg, Chairman of Asia Pacific at Fitch Ratings, and TJ Kono, Partner at Unison Capital, Edwin Northover, Partner at Deboise and Plimpton. To set the scene, I think it's fair to say that there has been a sea change in attitudes towards governments over recent years. Just last year, 200 US chief executives said that they would abandon shareholder primacy in favor of a more balanced approach to governance. At the same time, global investors have been pushing companies across Asia for greater emphasis on the G in the ESG lexicon and lobbying hard for more diverse boards. Turning to you first, Edwin, will the COVID-19 pandemic derail this trend towards a more responsive and responsible corporate governance, or reinforce it?
Particularly in an age of the internet where consumers are looking more carefully at what companies are doing and they're commenting more openly on what companies are doing. And of course, you can have trial by social media as a result of that. Companies do have to be pretty cognizant of the kind of activities they're undertaking. Employment is an obvious one. A number of companies around the world, even in Asia, will have taken money from governments to be able to furlough employees for a period of time. And as part of that, they might have made commitments not to make redundancies. If people turn back on those kind of promises, there's going to be intense scrutiny of companies for doing that. So there's clearly going to have to be a management issue for boards as they go forward about managing those different elements of shareholder value and other stakeholders that are in the company. But it's been a very interesting trend because, of course, from a company law perspective, in most jurisdictions, and here in Hong Kong included, the emphasis has been around you create value for shareholders. The board is there. In Hong Kong, the board is there to act in good faith in the best interests of the company as a whole. And traditionally, that has been seen to be a shareholder model where you act in the best interests of shareholders. Of course, not all shareholders are aligned. You have small shareholders, you have activist shareholders, you have long-term investors such as pension funds and insurance companies. They're not always aligned on the outcomes. But the trend has definitely been over the last decade that companies have to think about much wider factors about where they sit in society, whether that's their employees, whether it's what their effect has on supply chains if they move business. It's about their environmental impact. And the pressure is there from investors. You mentioned that 200 companies there, Alison. We've also had BlackRock making statements about how important it is for them in terms of investee companies. I think the pressure remains there. And it's difficult for boards to navigate because in some ways they're doing it in a bit of a political vacuum because there isn't always the leadership from governments about what should be done, but there is the pressure from investors and the pressure from consumers.
Boon, turning to you, please. Could you give us a little bit more of colour on the corporate governance seen in Asia and the structures, particularly here? Do you think that that trend will continue?
Yes, indeed. So I think historically, you either have MNCs in Asia or dominant Asian family businesses that could also be listed on exchanges. And I think what COVID has shown us is that you could be faced with three challenges, one of which is a great opportunity. Your business would thrive in a COVID world, or your business has seen a significant drop in demand but would survive post-COVID, or your business model would be decimated with COVID. And I think in such an environment, as with corporate governance, stakeholder engagement is clearly very important. So engaging your customers, your shareholders, and in particular, if you have seen a significant drop in demand in your business, but you could survive COVID, that engagement with all stakeholders in this period is clearly extremely important. In particular, explaining what is going on to your business model, what are the impact, and how could you reposition, and how will you do better when demand comes back. And in some of this conversation, you may require capital. And I think we've seen that in the last few months for companies that are faced with a viable model, but seeing a significant drop as of now in demand.
Thank you, thank you. Turning to you, Matt. Fitch has introduced ESG scoring into its credit analysis. Could you give us some insights into what you've understood about investors' concern over governance issues?
Well, I'll start by saying that I spent a period of time as a board director of a publicly traded Australian company. And at the beginning of that tenure, there were virtually no ESG questions. And by the time 5 years later that we ended, I would say a significant portion of the questions at the AGM and that came into management were ESG related. And so when Fitch introduced its ESG product a couple of years ago, it quite frankly met with a great response from investors. And from my perspective, one of the best things that it did is in a very transparent way, went out and identified the key ESG factors, or in this case, the G factors, and provided a basis for conversations between investors and issuers. And it forced, the issuers to address these with investors, and it provided a independent party's view about how relevant these were for the ratings and for therefore a company's ability to finance itself, particularly important in times like these, and opened up a real avenue for productive conversation for everybody to understand how important it is going forward.
Thank you. TJ, in some respects, I'd say that global corporate leaders are turning Japanese in that they've got a more balanced approach towards the stakeholders. And would you say in your experience that this ethos has created a more resilient company?
Well, I think it's true. The Japanese management model has had, in general, a little bit more balanced approach to interest alignment amongst a lot of stakeholders, not just on shareholders, including creditors, employees, and business partners, often forgotten. But that's also been a part of criticism on Japanese management, returns on equity or the speed at which they make decisions. And this business model or management model has its sort of historical background a little bit, how the companies were formed, or in Japan, the capital market was very much dominated by commercial banks instead of the shareholders. So how the money flowed in the market had a lot of impact on that as well. Now, setting aside what's a better model or that discussion, the COVID or this type of crisis has highlighted this stakeholder model is a little bit better fit for survival, a longer term perspective survival. An example being maybe concentrating a supply chain would yield a better, cost structure in the short term, but, it adds challenges when there are crises like this. So, I'm not certainly here to advocate a Japan model, and it certainly has its flaws, but it's the crisis like this, brings a little bit different perspective. Now, this whole idea of kind of balanced approach, I think, market, whether it's going through more of a growth period or a little bit more difficult times like this, the management model where it gets attention shifts a little bit. There are times when Japanese model gets criticized again, like I said, on return equity. So now, as far as this balance idea though goes, I think what my fellow panelists have mentioned in the past, this idea of focus on ESG, I think is a big game changer. ESG aspect coming from investors and again, many stakeholders, I think is what enables, but at the same time forces many of the companies to look at the idea of balancing very short-term gains versus a long-term perspective. And if you want to call that a kind of a Japanese model, I think it's becoming somewhat of a norm in global markets. That statement, I probably agree with that.
Can I just tag on a quick question on Japan?
Sure.
In the post-Abe era, do you think that the push towards a more focus on ROE will falter?
The short answer is no. It has nothing to do with administration or the political agenda. I think Japan is maybe an unfortunate front runner of a developed market that has had a very low growth. And it seems like the global market, or at least the developed market, is heading in that direction. And add that to demographic changes and some of the structural changes that this country is going through, the result of that is higher return on equity is much needed to pay for many things, whether it's a pension or healthcare system, whatever the case may be. So a lower yield on equity or return is not necessarily a part of a survival path for many of the companies, but also just Japan in general. So my short answer to that question would be strong no.
Good. Boon Chye, turning back to you, please. Are stock markets globally hitting the right balance between trying to get market debutantes to list, to come to their exchanges, and holding the line on corporate governance?
Well, exchanges will not compromise on governance standards because markets cannot afford to lose the trust and confidence of investors. And markets do compete for capital flows from investors, and therefore integrity is essential for capital markets to thrive over a longer term. That said, I think for markets and any market operator or market infrastructure, it is important to strike the right balance. You have to allow companies to innovate and evolve, because enterprises will come up with new ways to do businesses, and company structure, market structure will change and evolve. We as the SGX play our parts with constant engagement with various stakeholders in the ecosystem. And in 2019, the Monetary Authority of Singapore set up the Corporate Governance Advisory Committee. It is a permanent industry-led committee, comprises of many segments of the ecosystem. And I think the message is corporate governance is clearly important, is at the forefront, but it is also evolving, and having a market-led permanent committee to advise, I think is one of the many important inputs into ESG focus for everyone in the system.
Indeed. Matt, can I bring you in on this? So, as a former investment banker based in Hong Kong, How do you see the evolution and of the stock exchanges approach to corporate governance?
Well, I think I would first of all agree with Boon Chye. It's a very tricky one because clearly you have investor rights and you have companies that wish to operate in a particular way. I don't mean in any way, shape, or form to trivialize voting rights, but I think when investors decide whether or not to go into a stock that has, in some way, shape, or form, gone away from one share, one vote, they're going to be exceptionally focused at all of the other governance aspects that are in place, i.e. independent directors and other outside pressures that can be brought to bear on management. Speaking personally, it would have to be a very special share to want to own in order to, to give up my right to vote as a shareholder and affect real change.
Thank you. Looking ahead, as I do actually want to bring in the US-China trade war a little bit here. I mean, an open question, how do you guys see the impact on corporate governance from these tensions? And Edwin, if I can bring you in on this, how can boards navigate such a politically charged atmosphere as there is at the moment, and find a way between potentially conflicting stakeholders at this time?
It's a politically charged question for a politically charged issue. Yeah, I think in some respects, COVID has been a useful, experiment for this because, it's allowed companies to see what happens when there's real disruption to their business. And so we've had all kinds of issues about business continuity, about supply chains, where a business is able to get its resources from, how it can cope in the short term to get through to a longer term issue. I think that somehow in many respects has been helpful because clearly where we are with the US trade war and China trade war is nobody quite knows which way it's going to go. And so there's a little bit of companies, I'm sure, sitting on the fence to wait and see what happens come the election in November to see whether that makes any difference. But I think most sensible boards would be thinking about about options, about how they should, if worst case scenario, there ends up being two separate poles, spheres of influence, one in China and one in the US, and you kind of have to pick which one you want to be, then you should start planning about how your business fits into that. That is a lot easier said than done because there are obviously some companies which perhaps make things in China where maybe they could find different supply chains, or there are other companies which of course are using US dollars and would have to think about how they would be able to manage in the future in terms of their contracts and their relationships with banks. So there's internally, I think it requires boards to be doing due diligence about how their footprint works, which markets are important to them, and thinking about stress testing their businesses about what the outcomes might be.
When I share Edwin's comments, not just on boards, I think even for management, the US-China geopolitical situation really warrants a relook of how supply chain for the companies organized, regulatory risks, even how you cover your customers, and even the different businesses in terms of how they organize and incorporated. So I think it's really bringing for the board and management corporate governance to the forefront.
Matt, would you like to come in on this, given your background in finance? We touched on the stresses on financial institutions there.
I think, Boon Chye and Edwin, have covered it mostly. The only thing I'd say is just strictly from an investor perspective, demanding good governance at the board. I think, if nothing else, this just heightens the desire from investors to see boards acting in a very active and responsible manner to protect the companies that they've invested in. So it's hard for me to see that this would in any way lessen, a call for good governance.
Thank you. TJ, turning to you, as investors assess which companies will survive this pandemic and which will unfortunately fail, how can sound corporate governance improve a company's ability to adapt to the new normal post-COVID? What do you see, and avoid becoming the next Blockbuster?
Sure. We as an organization, as a fund, we've only invested in companies where we can actually take control of the business. This is with the premise that the control comes with our ability to instill changes or adapt to changes in market conditions and so forth. Now, when it comes to corporate governance, though, what we think about, particularly when we try to survive a challenge like this, the corporate governance is not necessarily just about structure. It's not something, for example, just a number of board seats or, what kind of rights that you have. It's when we think about the governance, we think about things that are not necessarily that can be written into contract almost. And what I mean by that is corporate governance at the end of the day is really a decision-making infrastructure. And that allows the companies to adapt and install strategies and so forth. And this structure is very different for each company. There's no one-fit-all kind of model that we look for today. And, for example, a family-owned business where there's a very strong personality that makes a lot of decisions and has very history attached to it versus a subsidiary of a larger group or a public company, or a retail business that sees the performance of its business on day-to-day basis. It happens very quickly versus a capital intensive business where an investments that you make and the fruit of that comes a few years later, or a very cyclical business. Or for us, Japanese companies that tend to be better at bottom-up approach to decision-making as an organization versus many of the Korean companies where it's a fairly top-down approach is more popular. So our job really is to design what works for that organization, for that business model, really the right corporate governance structure that allows the companies to adapt at times like this. Now, in the end, we think the best structure, or what makes it the commonalities among the different types of structures, is really the companies that can figure out issues and have solutions on its own and brings that to a ultimate decision-making process of board of directors or shareholders meeting. And that decision-making layers, there are many layers, but real, finding issues and finding actual solutions for it. And we talk about this kind of PDCA cycle kind of thing. An organization that can execute that process on its own and then bring the right topics to certain decision-making bodies, the structures or the entities that can do that autonomously is the model that we look for. And ultimately, we have the rights and we have the governance to really exercise our will. But it really the company has to bring the right issues to the board, really for the decision makers to make right decisions. And ultimately, it's really shareholders' job to figure out what the right corporate governance structure is for that organization. It is the management's responsibility to explain what is happening and to explain the decision-making process so that the shareholders can figure out the right way for the right corporate governance for that entity. And it's easier for private companies, but even for public companies, the shareholders need to make those decisions. And it's not just the share price that the shareholders can look at to make decisions on the management or some changes to install in the business. So, for us, again, the corporate governance really is synonymous with the decision-making infrastructure and how that should fit for that particular business at times like this.
Thank you. Matt, turning to you. do you think that credit rating agencies have done a good enough job in flagging the kind of strains that we've seen on corporate governance over the last, 6 or 7 tumultuous months?
Yeah, I can't speak for our friendly competitors, but if you just look at Fitch and how Fitch has dealt with ESG, clearly, the last 6 or 7 months have been very, very difficult. And we've reevaluated our portfolio on a number of factors, which has led to approximately 1,500 corporates and 2,500 structured finance transactions seeing negative rating actions. But remarkably, less than 100 of these negative rating actions have been because of ESG factors. And if you drill down even further to governance, it's really only been about 40, with 30 being, downgrades, if you will, and 10 being actual upgrades. So I think we feel at Fitch that we did a good job when we went out originally and assigned, the governance ratings, which admittedly was very recent, and they were then captured in the overall credit rating, of the company. Clearly, times are difficult. Liquidity and leverage are obviously the 2 primary reasons why people are getting downgraded. And those are related to having good governance, because if you show up at your bank or in the capital markets and you don't have good governance in bad times, it's going to be much harder to get funding, whether or not it's equity or debt. But I feel like we actually have captured it, and that governance really hasn't been the primary reason why people have been downgraded at this point in time. I think it is fair to say, though, that we have obviously decided to pass on a number of ratings opportunities because we have had concerns about the governance at companies. For the same reason that Boon, Chye, and the SGX, for example, might pass on having a listing for the same reason if they're not comfortable. And then I think I'd add one further thing, that in this time we clearly are paying a lot of attention, for the companies for whom we have rated, about whether or not there are key shareholder, issues above and beyond the company, because you can get a knock-on effect at a group level if a shareholder or an affiliate company is in fact under duress, even if the actual rated entity itself isn't experiencing the same. So governance hasn't been an issue for a lot of re-ratings, but clearly it's forefront in everybody's mind because it makes companies more financeable, and ability to access the capital markets is a critical factor.
Thank you. Boon, Chye, can I bring you back in here? Do stock markets and investors in Asia understands the characteristics of Asian corporate governance a little bit more deeply, and therefore maybe create more value for shareholders, or what do you think?
Well, I think for progressive companies, if they can, I think should never let a crisis go to waste. And I think for those companies that have not quite embraced ESG, there may be a need to change mindset and maybe even company culture. Clearly has to see stakeholders as partners rather than a necessary cost for doing business. And I would say probably the following. In such a period that we're going through, more communication is clearly important. Guidance and engagement with staff, vendor, partners, regulator, government, clearly very important. And even when many regulators and exchanges have moved and helped companies in terms of electronic submission and electronic digital AGM, I think doing the right things and doing things right is important. It's not just about being able to now do an electronic AGM, but doing all means to try and encourage shareholder to ask questions and being able to have many channels to answer shareholder questions. So I think this is one where companies who are progressive and will not let a crisis to waste will probably emerge much stronger.
Edwin, if I can just get another question in quickly from you. I think in recent years, we've seen visionary tech entrepreneurs amass an almost sort of slavish following amongst shareholders as we've seen their share prices skyrocket. Their sways only increased during the pandemic. What corporate governance implications flow from this?
And I think that the pandemic has obviously increase the market share and the market importance of the digital economy. And, I think we have to ask ourselves in some respects, if this crisis had happened 15, 20 years ago, what would have happened? What would we have done? Because people wouldn't have been able to use the internet in the way they've been able to do to pay and buy things. And so in many respects, the digital economy has kind of been the savior of getting a lot of companies through the crisis and individuals through the crisis we've been through. So I think the sway is going to increase. I mean, we've heard already about, it's rules being changed or accommodations being made by stock exchanges to allow certain types of companies to be able to list there with weighted voting rights and so on. I think all that means when you've got a growing power of tech companies and slightly different rules for some of them in different places, that means that other aspects of good corporate governance need to come through. So of course, the independent directors, compliance with other aspects of corporate governance codes, I think there has to be a real focus on those, because clearly, when you've got different classes of shares and minority shareholders are not necessarily being, having equal rights as the founders of these companies, there has to be a bigger focus on the other aspects of corporate governance. So, but I don't see any kind of investor appetite turning away from these things. I mean, there's obviously been a little bit of, people want to invest in them because of the returns are enormous, and because of the stakes that they have in the economy. Clearly, there are some smaller ones where, as a result of the pandemic, investors have to think a bit more carefully about where their money goes, and so non-listed ones, maybe the money isn't quite as free flowing as it was before. So there's capital; they have to find sources of capital. But I don't see the challenges particularly coming from investors or consumers at the moment. I think the challenges might come in the future from governments deciding somehow some of these companies are just too big to fail. They are systemically important in some way, and therefore they have to be regulated in a different manner. Antitrust or competition issues are regularly threatened. And maybe consumers who get worried about the use of their data, whether there's a bit of a clampdown on how data is used, and governments worrying about tax as well, the tax basis of some companies. So I don't see it coming from the investors. I see it perhaps coming from different stakeholders.
Thank you. We're running out of time rapidly, unfortunately. So I'm going to have a quick fire question just to wrap up our part. Can I ask you, a decade from now, what percentage of boards do you expect to be made up by independent directors? So TJ, Japan and Korea, please.
In short, more than 50%. Just very quickly, Japan already, 56% of the listed companies have more than 1/3 outside board members. Korea has a legal stipulation that above a certain size, you have to have 50% outside board members. Now, it's not the numbers. It's really, at the end of the day, the quality of conversations and decision-making process that's being done at these board meetings is far more important than the number, where you can bring in a lot of, no offense, but you can bring in a lot of academics or ex-bureaucrats, just to fill the numbers. Is it really are they providing enough insight and to improve the decision-making process? I think shareholders have to ask that question instead of a simple question of the numbers and so forth and so forth. I just wanted to add that point.
Point taken. Matt, mainland China percentage?
I would say 50, up from a third now, but I just would completely 100% echo what TJ said. I mean, to me, it's really not the number. It's truly, are these people independent? Do they bring something of quality? And are they empowered in the governance structure to actually do something if issues go wrong? And I think those are the things that really need to be addressed more than just the actual number, although I do think the actual number will go up.
Okay. Boon Chye, Singapore.
Well, I share those two comments. I don't think it's the percentage per se, but that said, I think by 2018, about 70% of our listed companies had more than 50% of their directors on boards being independent. But I think it also calls on the question, when you look at a number, how do you define independence? A director could be deemed as non-independent because there is some professional services provision between the firm and the company, and frankly, that amount can be very small. And depending on what threshold you set, the person can be non-independent. And likewise, in terms of the number of years serving on the board, how to strike a balance between experience and the long tenure.
Last but not least, Edwin, Hong Kong.
I think we're all hugely in agreement here. But in Hong Kong at the moment, it's a minimum of 3 and 1/3 of the board have to be independent. Personally, I'm not sure that number's going to go up, but I think it's going to be it's the same issue. It's the debate about quality over quantity, and so I think that all those issues around the independence of those board members, what independent means, and also the number of these independent directorships that they're holding across different companies are the things that will be focused on, as opposed to the number.
Thank you. Now, turning to questions from the audience, I can see we've had a slew of questions, almost all asking about governance tips to survive COVID. A representative one, I think, comes from Prasanta. How can sound corporate governance contribute to the survival of SMEs during the COVID-19 pandemic? Can I ask Boon Chye, can you jump in on this one, please?
Yes, certainly. I think what is important is what do companies, whether you're big or SME, do during peacetime. In a crisis, as Matt mentioned, leverage, liquidity, these are very important factors. And if a SME during peacetime is clearly very communicative and engaging shareholders, stakeholders in terms of their business model, their plans, stress points, opportunities. In a situation like that, even if you're faced with a liquidity crunch and being able to communicate well with your stakeholders, you may jolly well be able to come to your shareholders for liquidity and capital. And I think it's always pre-crisis, during peacetime, what does a company do?
Thank you.
Alison, I might add, or just sort of somewhat echo Boon Chye. In my experience, when times are bad, companies, small, medium, and large, tend to withdraw on themselves, and the stakeholder communications sort of shrink. I think it's the time when investors most appreciate very candid conversations, and they will be understanding that you might not have all the answers, but incredibly appreciative of the fact that you are open and addressing the issues. And I think it will be very beneficial in getting financing, in keeping employees aligned, keeping customers and the like. So I would throw in stakeholder communications as a critical success factor.
Absolutely.
And if I say that, particularly on SMEs and in Asia, this whole COVID situation, even though the virus itself is very discriminating when it comes to affecting people, it's very polarizing on certain sectors and certain businesses. And I think SMEs have much harder time surviving through this than a larger corporations. That is our impression so far. And this is not just from a commercial perspective, but definitely this idea of capital flow. Coming from banks, coming from the public market, SMEs will have a harder time securing capital going forward. And that really means they have to step up on improving efficiency and productivity. And in particular in Asia, SMEs tend to be more domestic-oriented businesses. And going back to the idea of outside board members or whatever, people that can bring in a IT literacy, transforming digitalization or any kind of financing or that kind of corporate finance background that can help them on financing or merging with other companies just to survive type of ideas, sort of thinking a little bit outside of the box from a original business, will be needed in order to improve productivity. So this idea of governance in SMEs in Asia in particular, I think is a very fitting question when it comes to COVID's impact on business.
And I would agree. Can I just add, Alison? And in some respects, smaller companies or closely held companies, family-run companies, they have, in many ways, the benefit of agility because they can sometimes make decisions more quickly. But I think in the longer term, having a more robust corporate governance structure, I think allows them to get access to these investors and capital and ideas in a way that they shouldn't necessarily be shy of. So I think the trend there, generally, I agree with everybody, the trend will be towards more robust corporate governance structures in preparation for big shocks of this nature. It's not a bad thing to do.
We maybe have time just to sneak in one more from Tan. What corporate governance structures need to change for businesses to survive the COVID-19 pandemic? Boon Chye? What needs to change?
Well, I think we've seen through COVID, the staff engagement, staff safety, and I think broadly, we all talk about diversity of boards before. This really come to bear during COVID-19. I think we all, for prudence and for businesses, we plan for a pandemic, but frankly, I don't think we expect a pandemic to happen. So I think diversity of views, expertise, critical.
Thank you. Another comment? What needs to change?
Yeah, I think we talked about the balance among stakeholders. We talked about that. The second thing is, we face many questions that have uncertainties, and a lot of the boards and a lot of the commercial decisions being made at companies, we're being asked a question that we don't have an answer for, and it's really the corporate governance or the decision-making structure that can make decisions, not knowing or not having all information available, but be comfortable making decisions and then be able to come back to it and make some changes, and that sort of adaptability of the decision-making process in itself, I think it's something that's required in COVID because so much uncertainty from the virus situation.
Thank you. And with that, I think it just remains for me to thank the panelists for your insightful comments today, and to the audience for joining us. If you found this webinar useful, then please don't forget to log on to our next in our series in October. And this time it will be about employment in crisis. Find out best practices on helping your staff through the COVID-19 pandemic and much more. Look forward to seeing you again then. Thank you for your time. Goodbye.
Thank you.